Hello, everyone. For all of you who have been joining us, I'll put my camera on. I should be putting my camera on. There we go. Hello, hi. We'll just wait a couple minutes to see who else is going to join, and then we'll get started. Super awesome that you can be here today. Okay, just a second, and we'll get to it. All right. Hi. So thank you for joining us this evening. My name is Elliot Locke, for all of you who don't know me. I'm the co-founder and CEO of a startup called Abroadin, and I'm also the creator of the What the Fuck is Going On with the Economy newsletter. To give you a little bit of a background on that, if you're not familiar with us, I started this, we started this 3 years ago, right at the onset of the pandemic. That time I was in a co-working space, and we were all working from home, and we were doing these like regular video calls to keep ourselves company. And I decided, you know what? Well, I volunteered to talk about what was going on with the economy because it was kind of a scary time. And that actually wound up becoming the newsletter that we ran. Well, we're still technically running it, but we ran for over 3 years. And it's quite cool because, right now we're very busy with some other stuff, which is why it hasn't been published lately. But we're trying this new format with the video. And it's quite cool because I'm actually in that same co-working space this month where the video idea originally started from. So it's kind of a full circle thing. And to give you a little bit update here on Abroadin while we're doing this, we're a financial well-being platform for people living abroad. And we're making a lot of progress to get everything launched, which you can imagine is tons of work. But I know that many of you enjoy reading this newsletter. It has like a 50% open rate, which is phenomenal, blows my mind on that. And I've gotten some good feedback, and I know how much you all are interested in this. So I thought, you know what, let's do this as a live stream and go from there. So yeah, speaking of that, let's just hop to it, right? So it's been a while since we've last spoken, or you've heard from me. I think it was like the end of March, and there's been a bit happening right there during then. And the first thing I'd really like to take a look at is the inflation story and where we are in that, right? So if we go back to the beginning of the pandemic and everything got all shifted around in early 2020 as we radically changed the way that we were interacting with the economy, going from services to goods and then ordering all these goods. It led to these supply chain issues that really began manifesting in late 2020, early 2021, as not only did companies have to get used to an e-commerce model, but then the whole back behind it where the manufacturers and the logistics just couldn't keep up. And that led to this first really push of inflation where there was just hard times for people looking to get products, right? You'd see inflation and the price of shipping containers hitting massive highs. You'd see used cars going up. I remember I think it's our 10th or 12th issue of the newsletter. We talked about how rental cars were all messed up because of the business model behind that. And then impacted used car prices. And well, as the supply chain issues started to abate in late 2021 and everyone kept up or got up to speed and we were getting back into our open service economy, we entered into an energy crunch, right? So late 2021, what had really started to happen, Putin began to twist the screws on and turn the screws on the gas supply coming out of Russia. And now looking back on it, this was actually him setting up for his invasion of Ukraine. But at that time in late 2021, energy prices began to climb up. And we have a graph showing this here in just a little bit. But what is quite interesting there is energy prices as they went up, and then after the invasion skyrocketed, that's rippled through the economy. We know how much we're dependent on oil and gasoline or petrol for our cars and for our transport. Manufacturing needs the heat and the energy of gas to produce goods and services, and just our grid isn't as green as it probably should have been, despite all the talk. And that led to this huge run-up in inflation that really started to rear its head last summer. If you remember this time, and again, we'll show this in the graph, that energy prices were in a crazy bubble. And as soon as that started to kind of cool off, the inflation narrative had gotten embedded into our heads and into our mindset, right? And that was sort of an opportunity for companies who had hedged themselves well, who had managed to set themselves up well financially for the high energy prices and supply chain issues, who had good margins, to see how far they could push their profit margins. And that led to not every company, but many doing what was known as profit-led inflation. And again, we actually wrote about this in October when it started to come out, and there wasn't the clear data, so it was really hard to say what was happening there. But as time has gone on, there's been a lot of reports, reports is maybe not the right word, but a lot of academic studies coming from economists, coming from central banks that are identifying this. What was interesting, I remember reading one report from Allianz, the insurance company, saying that the big drivers of profit-led inflation in Europe are actually the low-cost grocery stores like Lidl and Aldi and those discount retailers, because they had full control of all the brands that they sell in their store, or the majority of them, and they could push those margins up. And what's happened lately is, as we have maybe gotten wise as a society, we've said, wait a second, I'm not paying that much for whatever you're selling. And combined with government regulators saying, whoa, those prices are too high, we might have to take action, just the threat of it, that started to cool off. Well, that's kind of led us to where we are right now, where we're maybe seeing wage-led inflation, where what usually happens in an inflationary cycle is that people will demand more pay to keep up. And classically, in an inflationary cycle, wages are what drives it up. But also profits can have an impact and a role in there too. So now that we're in this sort of wage cycle that we think, what's next? Could it be food? We'll get into that a little bit later, but it's certainly something interesting to think about. And what we're looking at here in this inflation story is what the economist would call as transitory inflation. Transitory inflation was, I think, largely misunderstood by a lot of people in the media or online, or pundits, I guess, if you'd want to put it that way, blowhards, I don't know. But what transitory meant was that it was passing through different sectors of the economy and through different phases. It wasn't that it was going to just come and go. There was a hope that it would. But really, in that sense, how they're talking about it, all inflation is transitory. It will eventually peak and come down, unless you're Argentina. But that's a whole other webinar or live stream to do on Argentina. And I've talked about this before with our many Argentinian friends here. So, but yeah. So this was transitory, and that kind of shows what it is. And you could probably say, and this has actually been noted by many economists, that central banks have done a terrible job on communicating this stuff. And the central banks, they have to be very clear on this, because markets and investors and companies, manufacturers, producers, they all are listening to what central banks say, because what they do are they control interest rates. And before we get to the interest rates, I just want to show you something about what's happening here in inflation. if you've heard me give this talk or you've read the newsletter before, I give talks occasionally in co-working spaces here in Barcelona. But I love the European Central Bank's inflation dashboard, and it gives you this overview of what's going on in the economy in terms of different sectors pushing up inflation and what's happening there. And I actually think I don't have my cursor turned on the streamer, but if you look over here, you see that giant peak after January 2020, and you see it's going down, and inflation has been going down pretty much since the beginning of the year. This data actually just came out yesterday, so we're measuring what happened in June of this year compared to June of 2022. And yeah, in Spain, for example, inflation is at 1.6%. The lowest one, according to the ECB, is Luxembourg. And I'm going to just open this tab, so hopefully you can see it. And it's quite cool. You can play around with it. You can see the different sectors. So like food is driving prices up right now, as we were talking about. But things like housing and housing costs, like energy, are way down, for example, right now in Spain. And that's helping to balance that out. Education costs are in a good range. And yeah, recreation and culture are up, restaurant and hotels are up, which is kind of normal because we still have pent up travel demand, not like it was last year, but it's still driving it. People still want to travel. They still want to spend their savings, because we do have a lot of savings behind us. But yeah, so it's interesting. There's a link, by the way, there's a downloadable. If you're not subscribed to the newsletter and you're watching this, go ahead and subscribe. Gotta plug it, right? But I'm going to send out a supporting guide that comes with this if you're interested. So feel free to hop on that list. And yeah, so that it's very interesting to look at that, what's going on with the inflation story. But again, going back to what I was saying earlier was, interest rates are what everyone's watching, because the central bank sets the interest rates, right? Just to give you a little bit of an intro of how interest rates work, right? So the central bank is their job is to control the supply of money. And one of the primary ways they do that is through the interest rate. And they can do it two ways. So if the economy is a bit too hot, like it's under a level of inflation, they'll raise the rates. And the idea is that with higher rates, companies and people don't want to borrow as much because the interest payment costs are much higher. And instead, they won't make these investments that they want to do. Like they won't go out and buy property like they were before, or at least at the prices before, or businesses that want to borrow money for a big project, they might not do that. They might put it off. And on the flip side, with higher interest rates, in theory, banks will raise the deposit rate that they're charging or they're offering to customers, and people will save their money instead of spend it. And that takes the cash off of the economy and, in theory, cools it off. So what more or less happened after it was clear that the last transitory phase of inflation, pretty much the supply chain part, wasn't the end of the story, where Russia's invasion really flipped everything on its head. They had to act fast to raise interest rates. And there's a lot of debate on how they communicated it, when they would have done it. We've talked about it before. Again, the issue with interest rates is it's a powerful tool, but it's blunt, and you'll wind up killing parts of the economy or impacting parts of the economy you might not have wanted to or might not have considered, just because it's just that broad of a tool. So what everyone's trying to figure out now is, well, what's going on with the interest rates, right? So most central banks around Europe and the US and Canada, the West, pretty much, there's some exceptions there, but by and large, they all started raising rates between 18 to 12 months ago. The ECB, the European Central Bank, was a little bit behind on the curve, so to speak, or I guess late to the game. And pretty much since last summer, they've been raising rates from 0 all the way up to right now at 4%. The US has done something similar. And as we saw on the graph, and we can see a similar trend in the United States as well. The UK is a bit of a different story, but the UK is in a little bit different of a situation. Again, we can do a whole thing on that. But as we've seen, the economy in terms of inflation is cooling off. The economy in a lot of ways is sort of slowing down. So now investors and banks and manufacturers, pretty much everyone, is watching what's going to happen next. Are interest rates going to go up? Are they going to go down? Are they going to stay flat? And the consensus seems to be that they might go up just a little bit more, or they might remain flat. It's not about time to cut them, but what happens there is really going to impact the way everyone is thinking about it. It's going to impact the exchange rates, because what drives exchange rates are depositors looking for a higher return on their money, and if one currency has a higher interest rate that they can make their money on, they're going to put it there, or in anticipation of there. That's why the pound has gone up, because the British Central Bank, the Bank of England, has said they're going to keep probably increasing interest rates. No one knows what the Federal Reserve is going to do, although it seems flat, and the ECB is the same. So that's actually why there's been some volatility there, but it's certainly not the only part that's been volatile. So let's look at some sectors that are probably worth paying attention to. And first, what does raising interest rates mean for banks? If you'll recall, earlier this year, there was a bit of instability in the banking market, particularly in the US and with smaller banks, as well as with Credit Suisse here in Europe. More or less what happened is what banks will do is they'll take deposits and they'll do two things with them. They'll loan out money to people who want to borrow it, and that provides them with income from the people paying the interest on the loans. And then whatever's left over, they'll take those deposits outside of what they have to keep in cash reserves and invest it in treasury markets, so government debt. And the idea is that if government debt is very secure, it's backed up by the full faith of the government. Here in the developed world, it's really not an issue for the most part that governments would default on that. And what this pretty much means is, like, if the bank has higher demand for deposits, then they can just sell that government debt, or if they've been smart, they have it kind of chained out, and that debt will just be expiring, and they'll be getting the cash, and they can choose whether or not to reinvest it. Well, what happened when interest rates went way up really fast was that all of a sudden, when the banks had a high demand for deposits to be withdrawn, they were sitting on all these loans, this government debt, the bonds that they had borrowed, but they couldn't sell them as the interest rate on the bond they were borrowed was much lower than the rate that the governments were charging. So no one wanted to buy it. Like, it would be I could buy a bond that pays me 3%, or I could just park the money with the government at 5%. It's pretty no-brainer. So I would have to sell it at a discount, or haircut as it's called. So banks are in this situation. What happened in the US was those banks failed because they couldn't sell their bonds enough to meet the demands of their customers who were trying to take their money out. Classic bank run. Right now, as rates are up or steady, banks have kind of been holding on. Here in Europe, aside from Credit Suisse, most of the banks are very secure. At least according to the reports coming out of the regulators. A lot of that has to do with the banks being not so numerous. There are only a few banking brands in each country, like 4 or 5 seems to be the magic number. And that more or less means the banks are secure. Like, they don't have this lower risk. The banking sector rather is secure, as there's not that lower risk behind it. Now, the other side of it is the banks will be taking in deposits and wanting to make loans with that. And they're kind of hesitating on that front because right now, and as you've probably noticed, they're not really paying very good interest rates on their savings accounts and their deposits. And what they're pretty much doing is they're parking their money at the central bank, and they're making an arbitrage, or they're making money on the spread between the deposit rate that they're paying, maybe 0.5%, and the 4%, or what was it? Up to 4% that they have at the European Central Bank. Some regulators are not happy about that. Neither are some politicians. The way the banks see it is that they're trying to really preserve their cash and get ready in case things get volatile. I kind of see where they're coming from. The other thing is, like, when banks are trying to be aggressive about growing or making loans, they raise deposit rates to try to attract new customers to deposit that money. And they just don't seem to be doing that right now. So that's something to kind of be looking at, because again, the banks will drive economic activity. Speaking of lending money, what does all this mean for real estate, right? So the real estate sector is probably one of everyone's favorite sector, and I've been doing a lot of studying on it just because it's been really fascinating what's happening. And it's sort of a tale of two different markets, right? So you have if you think about real estate in two broad terms, you have residential real estate, so like houses, and then you have commercial real estate, so buildings, warehouses, shopping centers, those sorts of things. The housing market is more or less stable. Prices are kind of cooling off right now. Again, mortgage rates have gone up to the point where it's become way more expensive to borrow, so that starts to bring down prices. But the issue is this is not like 2008 when there was just a bunch of toxic mortgages on the market. People are in pretty good shape because the banks really increased their standards for lending, and that made it much more difficult for the market to get into a position where it's at risk. The other half of it is that, well, over the past 10 years, we just haven't built enough houses. So there's just not enough supply to meet demand. And that creates this floor where prices are never going to go below it. And you throw into the fact that we actually have pretty strong employment right now. There's still enough cash in the system to support the residential real estate market, even if it's showing signs of slowing down. Commercial real estate is a whole other ballgame. So commercial real estate, like office space, has suffered quite a lot recently with working from home since really mid-2020 when the return to office didn't happen, and there's still a ton of demand for remote work. That's been very difficult for that sector, just because no one really wants to go into the offices, particularly in places like the United States or like London or bigger European cities where they have that sort of concentrated office space with modern buildings and skyscrapers. The issue that's impacting them are two facts. So first, there's just not any demand for it, or demand's much lower. Second, the way that commercial real estate tends to work is that an investor or a developer will go out there and they'll borrow money for their projects, either to build a building or to rent one out and to finance it. And they do this on short-term loans, so like 3 to 5 years. And the idea is that it gives them that capital flexibility. It's a little bit different than when you go out and get a mortgage for like 20, 25 years, and usually it's on a fixed term rate, or it's like the variable rates not as, like it's sort of set in stone what that's going to be. Well, what's happening now is like in 2020, 2021, when interest rates were really low and there was low occupancy in the buildings, the developers and the property owners went out and refinanced those loans or borrowed new loans at really low interest rates, right? And that actually helped them kind of offset the fact that the rent that they were collecting was much lower, but they could still service their loans. They could still pay their debt. What's happening now is those loans are expiring because they're only for 3-5 years max. And the office space and the commercial real estate investors are entering into an environment where not only are they having to refinance at maybe 50 times higher than what they were before, so going from like 0.5% to 5%, right? Like, but they're also going to have to 10 times higher than before, but like they're also going to have to like get into a situation where the rent that they're collecting is still low because there's no demand, and suddenly that rent isn't enough to cover the cost of the loan that they have. And that's causing a huge slowdown in that market. It's been first noted by the private real estate investors, like private equity funds and these other ones who've like put out money and done a lot of investing privately. And again, these are funding like pension plans and other insurance companies. So like it does in a roundabout way impact us. But then now we're seeing it in the public market. So for real estate investment trust, REITs, which we've talked about before. Then we have a training module that we're building on the new Abroad platform that will cover. But what's cool about that, the Abroad platform is cool. But what's interesting about the commercial real estate market is that because like we're seeing this decline in the REITs, the whole sector itself is in a sort of precarious space. One option is to convert office space into apartments or into living. That's easier said than done, especially in big buildings. There should be a link in the document to a video the Wall Street Journal did talking to some developer who's doing those conversions. It's really interesting. Highly recommend watching it just because it explains the process behind it and the difficulty. So it's not like it's easier said than done. And the more red tape there's a lot of red tape involved with it that impacts the prices. It's really cool, especially if you're into commercial real estate or just studying the market. But again, like it's something to watch, like how much pressure that can take. What's very interesting here, at least, is if there's going to be a big commercial real estate recession, it's not going to have that outsized impact like it would on the housing market. Oh, there's also a drought happening now. So we're talking about food prices and food inflation. The drought's been happening for over a year, and that's impacted the growing season, right? And the thing about food is like we have to eat a minimum amount of calories a day to survive. And that's not something that we can really easily turn on and off without completely messing with our bodies, our metabolism, our well-being. So that means that all of these food producers are trying to produce enough food to meet demand, but they can't. So when the supply doesn't meet the demand outstrips the supply, prices go up. To make that a little bit worse, just this week, Russia announced that it was going to get out of this Black Sea grain deal that was sort of a truce with Ukraine in terms of grain exports to the rest of the world, and they broke that. So that's caused grain prices to go up globally, which is a bit concerning because grain not only makes our bread, and you have wheat, you have corn, you have your hops and your barley for your alcohol and your spirits, but it also is the feed for our animals who produce our milk, our eggs, our proteins. All of this stuff is sort of impacted. So it's really kind of concerning how this is going to play out. Also, if you look at hydroelectricity generation, no water means no electricity from hydro, and you have to turn to alternative sources, which happen to be fossil fuels at this time. But that being said, there's some optimism for energy prices. As I was saying earlier on, it looks like energy prices have cooled off. I took this from the Dutch TTF, which is the market for natural gas in Europe, excluding Iberia. We're on something a little bit different here. And it's showing the price of a kilo of natural gas for delivery on the day. So like we'll do a module on commodities and futures, but pretty much this is what the price that you'd pay each day, and going back historically to mid-2021. And as you can see, it peaked last summer when we had this crazy bubble, and there was this concern that everyone's going to freeze and the economy was going to go into this massive recession. It didn't actually happen. We were very good about finding alternative sources through liquid natural gas. We were really good about being more energy conscious, which is great for the environment. And we were able to save some money, which really saved us from a harsh recession. We only had a mild one, like a technical one, very mild earlier this year. And with energy prices going back down, it's very encouraging. So hopefully rolling into winter, things are looking good. And well, with that, so is there a coming recession? It's an interesting question. Like on the one hand, it's quite possible. We have a lot of pressures. We have the higher interest rates. The idea is to try to slow down the economy. That would be really good for cooling off inflation. And to be quite honest, recessions are not comfortable, but assuming that they don't cause catastrophe, they're actually really good for the economy and for growing, as it leads to the reduction of inefficient businesses, the creation of new ones. It's natural. It's an evolutionary cycle, as you know, things are and on the planet and in life. The economy is no exception. I'd say the cases, for it would be that, well, yeah, we do have interest rates that are high. We're looking at manufacturing slowing down, although on the flip side, well, manufacturing might be slowing down, but services are going up. Consumer confidence seems to be actually okay, which is actually a pretty good thing. But there's just a lot of global uncertainty. However, we're 3 years into this decade, and it hasn't really slowed us down. We're quite battle hardened if one were to come. It's also worth noting that unemployment is still quite low, which is a really good thing. People still have some savings, even though they've had to burn that down during higher prices with inflation. There's been government support. What we didn't have in 2008 was that government support coming in from Congresses and legislative bodies, the fiscal support. That wasn't there to support us. And that more or less caused this sort of malaise, at least in Europe, during the past decade. And actually, the reason the U.S. economy didn't come back up as soon as it should have was just because there was that underinvestment, even though central banks were cutting interest rates. But from the pandemic, there was all of this stimulus from governments, from the EU, from national governments, that has sort of supported the economy. So if there's going to be a recession, and I mean, we're not crystal ball soothsayers, but like if there were to be one, it seems that we have the capacity to support it, given there could be yet another black swan event this year or the coming decades. The rest of this decade. I don't know. 2030, I hope is going to be much better than this one, but knock on wood there. So I would be cautious about it. There are some really good signs out there. There's some issues, some structural issues. Europe over here, we do need to embark on more growth just because our economy needs that to stay dynamic, to cover our social programs without having to cut them deeply. We saw what that looked like in France back in May when there was that pension reform. So there are things that have to be done, but it's not as gloomy as it seems. So, well, let's get to what about investing right now, right? Well, we at Abroad In, we're all about financial well-being. We're all about helping people to build their wealth while living abroad and finding the best ways to do that. And really, if you have it, we can go into this in more detail, but obviously the first thing you want to do if you're trying to invest is to define your goals and, plan from there, right? But if you're making like a long-term investment, if like you're saving for retirement or you want to supplement your pension, you're thinking long-term, right? 10, 15, 20, 25, 30 years, maybe 40 years if you're young enough or you just love working. But over that, that's something, you'd want to think about. And you want to think about how to protect your money. If it's a short-term goal, it's something different. And what depending on what those goals are, will depend on what sort of investment you're going to make. Like if you have a short-term goal, like saving for a down payment for a house, savings accounts are probably still going to be your best bet in the fact that it keeps your money safe and the fact there's no volatility other than inflation, which is the risk. There are some banks out there that are paying higher rates. We have a link in the downloadable for a service that will aggregate at Raisin. There's some other aggregators out there that are interesting. There are actually other things like TransferWise, Wise, Revolut. Some of these other neobanks, they're paying higher interest rates. Make sure they have a banking license. Revolut here in Europe has one, so you have deposit protection. What Wise does is that you actually invest into an ETF that's investing in the overnight money market. It's quite interesting. There's a little bit of taxes involved. If you're an American, you don't even have to worry about that because they won't sell it to you. FATCA for life. But you'd want to define what you're doing. But if you're really concerned about inflation over the long run, equities, so stocks, shares of the company, nothing can really beat that, right? At least historically speaking, like they have been proven to, over time, consistently beat the inflation rate, which is probably the best way to measure your risk-free rate of return in that sense. And to kind of drive that home, I decided I would plot out two different sorts of investments. One is I would go back. So I went back to 1980, back when disco was dying, and I took $1 and I invested it and had it compound versus the rate of inflation, an imaginary investment that stayed rate constant to inflation. And then the other $1, I invested into the U.S. stock market in the S&P 500, so the 500 biggest publicly traded companies in the United States. That $1 by the end of 2022 was worth $3.80 or 55 cents. But that $1 that was invested in the S&P 500 was worth 98. That alone shows how much the value is from equities versus inflation. And pounding that message home, you go to a bank and you deposit your money in a savings account, they never pay the interest rate of inflation. So it's always going to be below that, right? So this real return would actually be a bit lower if you left it in just a regular savings account as zero, during eras where interest rates were low, equities are very high, and they make all of these gains. Over that time, that was an 11% gain. Over that time frame is 11% gain for the equities, 3% for 3.5% for the inflation, and that nets out to about 8% overall in the return. So it's been quite interesting to look at that. It's very stark. So if you're concerned about inflation over the time eroding your savings for retirement, it's definitely worth looking into like an ETF that invests in equities. Again, we'll be able to help you with that on a broaden, because I don't want to spill the beans, but we're going to have this whole chatting platform and the ability to book coaching sessions, tools, all this fun stuff. They'll let you do this sort of analysis and ask your financial questions that we get all the time. And there'll be tools so you can figure out which sort of ETFs fit your risk profile. So there's tons of stuff out there that you can do to protect and preserve your wealth while also growing it in light of inflation. Right. Before we finish, I've been doing these in co-working spaces, and I thought, well, why not? Let's just share a cocktail each time we do this. I asked ChatGPT to create this because, why not? Everyone's going into AI right now, and I don't quite trust the AI for financial services at the moment, but it's good for some time. So I thought it'd be fun to do a Singapore sling. I'm trying to do this here in Barcelona. I actually wanted to make this for the 4th of July to celebrate with Singapore's national drink. And I couldn't get Benedictine here, and I asked ChatGPT for a substitute to Benedictine, and it suggested Dom Benedictine. Still haven't found that. And if that doesn't work for you, you can have a vermouth. Nothing, yeah. If you're not in Spain or you haven't been to Spain, here, no one drinks the sangria. It's just a touristy drink. Come to Spain, you have a vermouth. You have it with an ice cube, slice of orange. Very nice when it's hot, like it is right now. So the recipe will also be in the guide. And if there are any questions, I'm going to go to the chat. And let me know. I really appreciate everyone who could attend. The idea is on the Abroad platform, we will do these sorts of exclusive webinars and broadcasts for all of you here who are members of the Abroad platform. Be very cool to have you all there. And you'll have more information on that as we'll launch it. We really want to bring the newsletter back. Again, it's a question of time. I like to provide quality content out of that, and with quality content from that, like it takes time. But I think it's worth it in terms of the information we give. But as we're trying to sprint through and get this new product launched, it's unfortunately I had to cut something down, but I would be really happy to bring it back. All right. But I think that about does it for today. This was really awesome. Please let me know your thoughts on the format, if this makes sense. If you like it, you don't like it. I'm not going to ask you to ring the bell, subscribe, or whatever it is, although you could. Because if you're also subscribed to the newsletter, I'll be able to send you a message there. Well, you'll get the newsletter. But this has been pretty awesome. Thank you all so much. I really appreciate it. Have a wonderful evening. And if you need anything, just send me an email. Have a great one.